Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Eddie Ring. Eddie is the founder of New Standard Equities. He founded NSE in 2010, and he's currently serves as the CEO. He's responsible for their investment strategy, operations, risk management, investor relationships. And Eddie has over 25 years of real estate experience, with 16 years dedicated to investing in multifamily. And they really particularly focus on the Western U.S., including Seattle, Northern Southern California, and San Diego. And the really interesting piece is that prior to this, Eddie was a comedy writer for a number of shows, it looks like, and even for the Larry Sanders Show, as we were talking before. So I think really fascinating journey to dig into. So Eddie, thank you so much for being here today.
Hey, thanks so much, Kent. I appreciate you having me on. Yeah, that's kind of funny. No pun intended, the comedy background isn't talked about a lot these days because, now it's so long ago, but it was formative.
Yeah.
And, it's an interesting world, that's for sure.
I'm sure there's some good stories there. I'm sure you got a lot of good stories. But I think it's a great place to start, right? Because a lot of people come into real estate investing as a second career. I found I did personally. I was a management consultant for 12 years. A lot of, we see people from all different backgrounds. So tell us how a comedy writer became the CEO of a prominent real estate investing firm.
Yeah, it's it sort of stems from I think my core values, and not to sound hoity-toity, but I was working as a sitcom writer, and what that means is you're working in the business and doing it's a really ton of fun. You sit around a big room and you're making jokes until 3 a.m, and you're drinking coffee at 9 to get back to the set so you can see if your jokes made any sense and make work or whatever. A lot of fun, up until the point that I had my second baby. And because what's not so fun is A, being away from my kids, and B, the work part of being a writer is fun, but the out of work part of being a writer is not so much fun. So as a comedy writer, even 20 years ago, I was out hustling and looking for work, 40-50% of the year. And so how I grew up was, mom and dad sit at the table and have dinner with the kids every single night. And that just, it just was a normal behavior that I wasn't able to replicate. And I think that actually is what drove me out of the business and into something a little bit more stable. That on top of it, just real super quick, I remember distinctly getting some report from the Writers Guild that showed the age of the average writer in Hollywood, and it was like you become old at about 40, maybe 42. And there was a nice little graph, and I looked at that graph, and I did some real quick back of the envelope math and made another graph of what it would take to retire at 42 and what I'd have to have in my bank account at that point in time. And wow, the two graphs just fought each other like nobody's business. And then I thought, wait a minute, if I'm putting up graphs and I'm looking at charts like this, maybe I ought to go to business school. So I put the pen down and went to UCLA and fortunately got in, and the rest is history. But the really funny thing is, once I was at UCLA, I was trying to figure out where to go and what kind of career to head to, and I stumbled into a real estate conference that they happen to have at the school. And I'm looking around and it's all these old guys. I'm like, what the heck is this? And then I was actually on my way to an entertainment industry sort of event And I went to the entertainment industry event. I see all these like they look like kids to me, like, you know, their suits didn't fit and there's almost no facial hair. And I was like, wait a minute, what the heck? And then it dawned on me that real estate has actually got some legs. And so that chart that I was talking about at the very beginning, where you got to make X by 42, in real estate, you know, 92, you got so much, you know, leg room that, you know, it just made me feel like, well, I can actually deliver on my own moral, social values of, you know, being a family person, as well as, you know, somebody who wants to actually, you know, have a career that was somewhat engaging and creative. So I shifted my entire focus into real estate, and here we are today.
Yeah.
New Standard Equities, I started the firm in 2010. We have about 18, a little bit under 2,000 units right now under management. We are fully vertically integrated, which means I do all of the property management, the asset management, the construction, all the accounting, obviously. And we have a mixed bag of investors. We have some high net worth family office type investors that are putting in 25 to, you know, to $1 million in every deal. And then we have some institutional investors that are putting in, you know, considerably more, you know, call it the 15, 20, $30 million per asset. And, you know, depending on the acquisition depends on the type of investor and type of deal structure that I put together. But it's been working out pretty well for us. We've got an average IRR of 29% on about 4.5-year holds on average. That's a investor multiple of about 2.6. So we're doing pretty well. Right now, it's a real challenge out there. I'm sure your listeners know about that, but I can go into that as well. But it's a very interesting time to be in our shoes.
Well, absolutely. And and yeah, we'll unpack a lot of those things that you touched on. So I think that's a great place to start. And just hearing, I mean, there's so many things about your story that resonate with me and my own personal journey into real estate. It was similarly driven by family and the need and want for time with family. And for me, it was traveling and doing things for clients. But I understand that it's similar in that real estate was able to give you that, call it work-life balance or whatever you'd like to call it, where you have the ability to, you know, be the type of father you want to be, which I think is fantastic. And then I think it's a really interesting comment about the young guys in the room versus the old guys in the room. And this idea that I think real estate investing does have that longevity because you know, you can create that great balance with it, and you can create, you know, you can really you stop having to trade your time for money, right? Which you were as a writer, and it was very unstable. And you move to something where you can put your money to work for you, that you don't have to, you know, you have to property manage, but you don't have to be on top of it day to day, making sure, you know, what's happening is happening. And so it gives you leverage there and the ability to, I think, afford more of that balance. So and I think that's why a lot of people go to real estate as almost a second career, it seems. I mean, just so many people I've talked to, I've noticed that theme in that. So yeah, I think just really interesting to hear your story and kind of how you got there. It resonates a lot with me and my own journey in this. So yeah, so as we look at NSE, right? So you've grown it into a sizable company over the last going on 13 years. I'd like to talk a little bit more about how you've scaled that business. I think how you've scaled it from when you think about going out and getting your first property, you know, and how it looks differently now. But also how and kind of why you went down that vertical integration path and what did that look like? You know, what were the first things you brought in, you know, and why did you do that? So I just love to just have you explain that a little bit to the audience.
Sure. Yeah, sure. I love talking about this because it's very much, again, focused on my core values. I got my training at a much larger firm, and so kind of learned on somebody else's dime. And they did not do their own property management. And there's different schools of thought around that. But what I realized while there is that with a third-party property management firm, if you use that type of structure, you're basically inserting somebody else's bottom line in between yourself and your NOI. So, in good times, that works out, generally speaking, because there's sort of alignment. But when things get rough, that alignment kind of evaporates. And so all of a sudden, what you thought was your great property management company is giving you the best people, but then you realize, oh no, their bigger client is asking for bigger, better people, and they're taking from your asset and you're being compromised. Mm-hmm. And so I saw that happening at my predecessor firm, and I realized that no, in order to really control the product at the end of the day, I wanted to take on the role of property manager as well. So a lot of my friends in the property management space thought I was insane, but it's okay, because I kept thinking that no, actually my product it's not just the box with the painted cabinets. It's the lifestyle, it's the ability to explain our value proposition to our residents. It's we actually have a mission here at the company. We deliver outstanding returns to our investors by providing the ideal living experience for our residents. So we're always trying to match that investor dollar with the resident experience, and to try to communicate that to a third-party property manager is really tough. Sure. But when I first started, it was I was full of hubris. It's okay. I learned my lessons. I thought I would start with, something somewhat small, like a 70-unit building or an 80-unit building. No, I started with a 20-unit building because that's all I could actually get under contract, and that's all that I could figure out how to finance and how to, how to have an investor that could, pony up a couple grand, whatever, alongside me. Yep. And it was very humbling. But at the same time, I thought, well, 20 units is fine, because now I'll have a chance to sit and actually build up the property management aspect of what I'm doing. And I brought on one person to help write checks. I couldn't even afford a printer. I literally was manual checks. Yeah. And this was 2010. The computers existed, but I just couldn't afford anything. So I just started, every day showing up at the asset and paying the gardener and paying the whatever and collecting the quarters that led to another investor seeing another owner, like an institutional owner that I knew, happened to see what I was doing, and I explained what the vision of my company was, and they said, well, actually, we have a couple properties in downtown LA. Would you mind managing for us? So I was like, sure, no problem. So then I went and hired a couple people who knew what they were doing, and went and got some more insurance and started building the management platform like that. I could tell you all the mistakes that I made for your listeners. I hired a cheap accountant. That was really a bad idea. I'm not talking about my CPA. He's great. Sure. But the day-to-day, she was very, very inexpensive. Yeah. And there was a reason for it. The numbers are everything. And so you cannot chintz out on the accounting side. Absolutely. The folks that I hired, a great maintenance guy, and he was fantastic. He took care of all my buildings. Humorously, I eventually had to upgrade him because he couldn't. As I got bigger, I became more institutional, and the insurance, everybody was looking at me a little closer. closer eyes, and unfortunately he couldn't produce proper paperwork to be paid properly in the U.S. So I
Sure.
had to terminate him. But at the same time, I kept upgrading all of my team. Like anytime that I had an opportunity to bring in a little bit more skill, I did. And you mostly through natural attrition, mostly the people that weren't kind of working out sort of faded and went off to somewhere else. But I eventually got to where I am today, where I've got super best in class type folks. I mean, my CFO is fantastic. He's been with me now 13 years, maybe 10 years. My COO has been with me for about 7 years. She came out of a very large institution. I managed to woo a construction manager from another company that has worked out terrific. And I find good people who want to actually work hard, play hard, but also really deliver on the core values of the company. And that's sort of the thesis in general of my life.
Yeah, everything's coming back to these core values that you've described, and that's kind of your guiding light. And I think that's a great way to grow a business, right? It's a great way to make sure people are aligned and give them something to something to point toward and go after. And so as you've looked at, you started out with property management in-house from the beginning, which obviously has its pros and cons. But what were some of the benefits of doing it from the beginning, and what were some of the drawbacks?
Yeah.
Maybe,
So,
yeah, go ahead.
because I was in the weeds, I was able to really speak to investors on exactly what's going on. Not just, the property, property managers love to say we're 95% leased. Like, okay. I'm able to look at that and say, don't tell me what we're leased. What's our exposure? What happens in 30 days? Where are we going to be? And I'm constantly like drilling down on those numbers and those metrics, and in a way that it would be almost inappropriate if I was doing that to a third-party property manager. They would get agitated. They would get, oh, you're too much in our shorts, and whatever. So I really I think that because it's everybody here basically reports or works for me. I mean, I walk down the hall and find out who's in eviction, why, and who's and I'm able to touch base on all of the details. And I'm the kind of manager actually that I need to know generally everything, but I allow people to make their own decisions and to run their side of the business. And I'm able to ask a few questions and know that they're kind of getting, there's guardrails on the bowling lane, they can kind of, I'm like, oh, I'm okay with them making their own mistakes too, because that's how you learn. But I definitely get a sense from everybody at the company where they are and if they're missing details. And I'm pretty good at sussing out whether somebody's missing something that I need to make a change about. So we're going back to that core values, and in the sitcom room, you'd all sit around a giant table, 15 people making jokes. I brought that into my company, not the humor part, but the collaboration part. So all of us on a daily basis are meeting and collaborating and working on issues from different perspectives. If it's construction, they're working on it from that perspective, or property management or asset management, accounting. And we really are a collaborative group. And that's one thing that I brought from the sitcom room.
Yeah, it's really interesting. It's always a balance of being able to separate and kind of, have everybody focusing and getting a lot done versus bringing people together to collaborate and what's the right time and the right amount. And, but it sounds like you've found a really good blend and brought some of that from your comedy career and just that experience of shooting ideas around and having those different perspectives and finding value there.
Right.
I think that's a great tip as folks look to build their own business. As you looked at, you started out with one property we talked about, right? But when you really started to scale, because I imagine there's a point where you really hit your stride and you start to amass assets. How did you think about and how did you grow your team as you started to get to, 500 or 1,000 units and you started to bring others on and bring other construction, different things in-house? How did you think about that strategically?
So I realized early on, actually, that there were a lot of really great people that haven't been given an opportunity. Um, and it almost never worked for me to put a job posting out on some job board somewhere and read a bunch of resumes. Instead, it was referrals, and it's been referrals for a long time. So I meet somebody, or I'm introduced to somebody, and they tell
Mhm.
me their story, and I'm understanding and listening and hearing, and I realize that, oh, this person is a really smart, individual. Like, for instance, this woman that I've got, she's an asset manager, and she was a capital improvement construction accountant. So I was like, oh, interesting, construction accounting. I said, well, what do you like about construction accounting? And she said something like, well, I like making sure that the vendor is doing what they say they're going to be doing, and making sure this and making sure that. And I was like, well, that feels a little bit like asset management. Would you ever be interested in an asset management job? And her face lit up, and she said, I've always dreamed about becoming an asset manager. So, well, we have an asset management manager position open. You want to join us? And so, yeah, great. So I now have
Yeah,
an asset manager with a strong background in construction accounting, which also is a good thing. So
absolutely.
it's that type of person that has been doing things maybe for somebody else in a different capacity, but I'm seeing a different strength, and then they get excited about joining.
And
And
how did you think
what's
about where to focus though? So, um, did you think about, okay, I'm intentionally going to go out. I've got my property management person, but I need to find an asset manager, or construction's been an issue, so I need to bring construction in house. How did you think about building the different building blocks?
So I basically went from I was doing everything to me and another person was doing everything to me and another person and another person, and we kept differentiating slowly and methodically. And it's a bit like it was for a long time. It was just in time sort of hiring, like,
Mhm,
yeah,
mhm.
you've got a pulse, great, but that almost never worked out. So I learned how to slow the hiring process down, and realizing, yes, maybe I'm putting too much on my team, but it's more important to go slow and hire the right person than hire quickly. And that was a real lesson for me. Find the right people that you work with, that you can jive with. They don't have to know everything. You
Mhm.
can teach them, or they can learn themselves. A lot of this is on the job training anyway. So when I started at my past firm, I was a comedy writer, so I didn't know. So I stayed up till 3 a.m. at the office, because that's what I used to do in the comedy shop. And, instead of writing jokes, I was doing underwriting. I was just figuring out, making it, just sort of teaching myself in a
Yeah.
lot of ways. But that's what it takes. I mean, when I moved into assets up in my first asset out of state was this thing up in way out of, I call it Greater Seattle. That's a stretch. It's almost Greater Canada. That's how far
Mhm.
north it was. And but told investors that it was in the Pacific Northwest. And I told my property management person at the time, I said, don't worry about it. You can get there in a couple hours after you fly for a couple hours. It was, but at the end of the day, I was right on the asset. And we were able to then take that flag that we planted in the state of Washington, and I got my, all the licensing and all of, things work a little different there with workers' comp and all kinds of interesting nuances. But I learned all of that on a very small property, call it, maybe it was 120 units or something like that. I don't know. But it was enough to basically build systems around various people that I had to bring in to kind of run that stuff.
Mm-hmm. I think there's a lot of value that you described in having that property management from the beginning, being able to kind of grow slowly, which, I mean, and you said a smaller asset, which to a lot of people, 120 units wouldn't be considered a small asset, but it's relative to what you're doing now, right?
Yeah.
I'm sure. Do you think that that slowed your pace of growth at all from what you would have done had you not had the in-house property management?
Absolutely. I know 2 or 3 firms here on the West Coast that built portfolios of 20 to 30,000 apartments in the time that I've built up to 2,000. I've had it maybe 3,500 tops, but we're talking about people who grew companies tenfold over what I've been able to do in the same amount of time or even shorter. But they're not property managing. And so the nuance is they still are sort of struggling with the idea that they're relying on another group to effectively do all of the legwork and do all the the hard muscle kind of effort. And I just don't believe that that's the way to go, even though you could scale a lot quicker. I just think that at the end of the day, your investors really appreciate somebody who is in the weeds, who understands the nuances of each submarket, and is ready to deliver the good news and the bad news, and not be kind of driven by trying to figure out what this third party is in the mix, your third party property manager. So it's just a core belief that I have, and I've planted my flag on that belief, and I don't think I'm changing. So
well, and it's worked out, you
Yeah.
know. And if you were to, as you think about property management, if you were to do it over again, or even just for advice for folks that are thinking about bringing property management in-house, I hear people often talk about a certain scale where it makes sense, and the number is different for everybody depending on who you
Right.
talk to. Is there a number, kind of a range number of properties, however you would define it, where you say, it becomes a lot easier once you have this scale, perhaps, or this is where maybe I would look based on what I know?
Yeah, I would say, first of all, yes, everybody told me, oh, scale is what you need. Property management doesn't become profitable until you've got 2,500 units or so. That's probably true. Maybe, I think that having a bit of a loss leader right now, we have too much of a loss leader where the investment climate is, but we can talk about that in a minute. But I don't think it's a big deal to basically invest in the company as a whole and have to come out of pocket to pay their people what they're owed, and provide quality health insurance and quality lifestyle and a 401k and all of that, which I provide. I think that it's a good investment on behalf of my investors for their investments in the individual assets. So the operating company generally pencils at about 2,000 units, maybe 3,000 units if I'm buying and selling in any given year. It works. Pure property management can probably be profitable at about 750 units. If you have really, really good people that can do a couple different roles.
Mhm.
You're not going to find regional managers that and your sort of chief operating officer type people. You're going to have somebody that is a combined asset and property manager, or somebody that can has the bandwidth to understand accounting but isn't necessarily a property accountant. And you're kind of mixing and matching and kind of combining roles.
Mhm.
But that's okay in an effort to grow a company,
Sure.
because when you go from 750 units to 1,000 units, you could probably afford another person, and some office space and a new printer, and that's
Yeah.
a new copier, whatever. I mean, these are the things that I did over a 13-year period. I started off in a home office, and then I moved to a tiny little office that had two little offices, I guess, embedded
Mhm.
next to it, or three embedded next to each other. I mean, really tiny, just about not much more than a desk. And moved into what I have now. But it was about 800 square feet when I first took this space. And then I took this space and kept expanding. And now I've got an office in Irvine and an office here. And, we have a great team, and we're ready to keep growing.
Well, I think that's just a fantastic way to outline that, of the benefits of and risks of bringing property management in-house at different scales, and kind of what you can expect and look for. Because I know there's a lot of groups out there. I mean, even ours, where we have third-party property management right now, and we've had a very successful partnership. Um, but you hear a lot of different, folks talking in different ways, with different scales, different ways to do it. So, but I think I love the detail around what you can expect at 750, and how as you get to maybe 2,500, how that looks
Hmm.
very differently. So appreciate that perspective.
Sure.
So just to switch gears for a minute, I wanted to talk about where you're operating, some of the geographies. We
Hmm.
don't have, as was saying earlier, we don't have a lot of people on the show who are focused on the West Coast, buying properties there. So I'd love to hear a little bit more about, what are you seeing in the market? Which markets are you targeting right now? Kind of why? Share some of your investment thesis with us.
Yeah. So we are very much West Coast operators, because those are the markets that I know. Um, I grew up in California. I understand California. I understand submarkets within the state. I know where I wouldn't want to buy, and so there's a locals sort of knowledge that I rely on. But the thesis that we look at, and my rationale for California and Washington, but California in specific, is that our incomes in California are much, much higher than the rest of the country. So our average household income in California is $111,000. That compares to about 72,000 for the average household in the U.S.
Sure.
And so with that, they can pay more rent. The rents that we're achieving on our one-bedroom apartments are started around $1,800, and two bedrooms tap out at over $3,000, just over
Mhm.
that. And but the reality is that falls right in between them. You got to make between $50,000 and $100,000 a year to support that rent, and people do in California, and it's not unheard of. And we have two properties up in the Bay Area. We have four or five, but one of them is in San Jose, where the average household is making 150,000, and in
Mhm.
Fremont, which is the East Bay, Silicon Valley, still it's 170,000. So, I mean, these are astronomical numbers when you're thinking about uh, what your average is, and those are our renters. And so I always look at that and say, yeah, but this is where all the the high paying jobs are. It's in California, and This is the knowledge economy, et cetera, et cetera. But what about the supply side? Well, unfortunately, in California, I say unfortunately because actually I'm worried about this as a member of our society, that we're not building enough housing. We haven't been building enough housing for decades now. We have in the Inland Empire, I was just on a panel talking about this. A gentleman was saying that there was a study that came out that the Inland Empire requires about 5,000 brand new units built every year. And that's what they require to keep up with the job creation and the demand. And we deliver about 2,000 units regularly every year. Well, that leaves us 3,000 units short in just that one segment of the state. And that's why in that same market, we have a couple of properties out there. I've moved rent. This is through the pandemic and everything. I went 75, 80% in the last 4 years. My NOI has almost doubled at my assets out in the Inland Empire. And that's just a couple of years. So, today with cap rates expanding and interest rates going much higher, I'm able to keep up with my values, property values, because of where NOI has gone. A lot of markets, you can't quite say that. So I look for that dynamic in various submarkets where there's a real supply imbalance, and where we can actually move rent because of the incomes.
Absolutely. And what is your perspective being the native Californian and having invested in California for a long time? And what's your perspective if there's such a demand imbalance and the incomes are so high? Why isn't there more building happening?
So the building isn't happening because of the politics. And it's not just like the lefty politics that are like, oh, we got to worry about, the environmental spotted owl, whatever all that stuff is, which great. I'm all for it. But it's the politics of cities, actually, who are, and the way our property tax structure is set, is that the cities don't favor housing. They want the tax revenue from retail. And that has always been the case. And so anytime the city is mandated to fulfill their housing obligations, which is currently in every single city in the state that's been under building, the state has actually come down and now has sued all of the cities for not fulfilling their housing obligations. And you know what happens when lawsuits become, I mean, it'd be years and years. So it was funny because I was thinking about this one site. I was talking to somebody about it. I had it tied up. I'm not a developer, but 20 years ago, I thought about this. It was 2005. It was an old Montgomery ward that went dark. And it was great location for residential. And I went to the city of LA and we managed to get into some councilman's office, and they laughed at us. They said, oh, no, that's going to be retail. I was like, well, it's next door to a Walmart. You're not going to put a retail here. This is residential. Sure enough, it's literally now coming out of the ground. In 2025, it's slated to open 620 units. Took 20 years,
20 years later,
20 years to entitle 620 units. I mean, that's the problem. Yeah. And so it's city driven and it's politics, but again, not, nothing other than, hey, we want that tax revenue.
Property taxes.
And it's, it creates a crazy, horrible social problem because, of course, limited supply increases demand and increases prices. So it's very challenging, and I don't see an end to it. So from my vantage point, I'd rather be in a state where I can kind of bank on not having a supply problem, really for the foreseeable future.
Right. I mean, that's a high barrier to entry. Right?
It's a really high barrier to look
at. So,
I
guess if you've got properties, you hold on to them.
Yep.
and
That's
rent
right.
continues to rise. But I imagine there's got to be a breaking point where even with I guess income growth has been so good that it's allowed rents to continue to increase. But I mean, is that the root of your concern that eventually rent growth outpaces income growth in some of these markets?
Yeah, for sure. And that's happening. And that's where that's when the state comes in with their moratorias and their rent
Hmm.
controls and all that business, because politically they need some kind of band-aid. Um, but ultimately the the silent hand, what is it, the unseen hand or whatever of the
Right.
market
Yeah.
forces basically wins out. And in some of the most stringent rent control markets in California, like city of Santa Monica or the city of San Francisco, I mean, pandemic aside, everything is a little bit upside down, but the values of those properties on a per unit basis are far higher than the values of non-rent control cities. And so what that means is, yeah, sure, maybe you can't raise your rent quite as high because of this tight rent control, but your unit keeps going up in value. So I'm talking about things in like Santa Monica where you can't buy a property today. I'm talking about a built 1970s vintage kind of junky thing. You're going
Yeah.
to be paying 700,000 a unit for that deal. Yeah.
Wow.
I mean, it's
That
pretty
is a
crazy. Yeah.
completely different perspective
Yep.
than I have being here in the Midwest.
Yeah, no,
Right.
exactly. That's it's hilarious. I mean, we can't build anything for under $600,000 of a unit,
Wow.
including land. I mean, it's obscene. Which means if we're going and spending, my typical stuff would be, oh, we spend 350,000 a unit, and we
Hmm.
improve it, and now it's worth 450 or 420 or whatever, and we could sell it, and then we make
Yeah.
money. But it's very challenging when you look at it across the spectrum. I always ask investors, new investors, well, where else do you put money out? If it's a joint venture partner, because I want to hear that if they're, big on, I don't know, Midwest or Kentucky or whatever it is, the Sun Belt, I know that my numbers are going to make them head scratch. And,
Right.
but if they're used to investing in California where the numbers just are flat out different, then they're okay. But it's
Yeah.
I've spent a long time trying to educate people, and it's very challenging to break that, that mindset.
Absolutely. Absolutely. Well, I think you've laid out a compelling thesis. I mean, the supply and demand at the end of the day is a very compelling story, right? Just that high barrier to new supply. And so Eddie, as you're looking at, let's say the next 18 months, right? What is your thesis? How are you directing the company right now?
So we've been hunting under every rock to find a deal that fits our model. And they're very far and few between. Right now, we're starting to see some very, very compelling opportunities, some newer stuff that maybe it's a lighter value add, core plus maybe,
Mhm.
in our markets that some of the institutions are forcing sales and whatnot. It's been very quiet though, for the most part. So we're going to keep hunting for that kind of stuff. And at the same time, we're looking for new investors, and we're looking for new joint venture partners from the institutions, and we're trying to set ourselves up for the next cycle. We've decided to sell one of our properties, just take some chips off the table. But for the most part, we're trying to operate to our best efficiency and find deals that make sense, which, it's tough right now.
Absolutely. And I think everybody's feeling that. I mean, even in our markets in the Midwest and Southeast, it's been quiet. The folks
Yeah,
that are selling are largely folks that are being forced or have to sell for some
right.
reason, just because of the interest rate environment. So, yeah. Well, Eddie, I really appreciate you sharing your perspective and educating me on some of the California markets and also how you grew your business because I think everybody has their own way of approaching it. I love your focus on core values, your focus on quality over quantity and controlling that process. So I think some really valuable insights there. And before I let you go, I want to take you through our keys to success round.
Great.
I've got 4 questions I want to ask you. The first one is, if you were a limited partner investor, right? You're going to invest in somebody else's deal and you could only ask them one question before you sent your money. What would that one question be?
I would ask that the sponsor, uh, out of all of the variables that are threats to this particular investment, which one keeps you up at night? Because we know there's always something,
Yeah,
whether we're in our own heads and living in fear or not. It's nice to sometimes articulate the one thing that could happen and could go wrong, as long as
sure.
that sponsor is honest.
Yeah, and I think how they respond to that tells you one, there's always something, right? So are they being honest
There's
about
always
that?
something.
How well do they
Exactly.
understand it? And what's their plan B, right? Or what's their plan in case that happens? So I think it's a
Exactly.
question that can lead to a lot of different good insights.
Yep. Exactly. Yeah. Yeah.
Very good. Next question. What are you most proud of in your career?
Um, I'm most proud of actually the team that I built. I'm proud of being able to give people a quality career, and good quality, high wages and whatnot. And I really get excited when when somebody has a baby or gets married or something like that, or buys a house. And I really feel great at being able to at least say I had a small hand in guiding them to some of these terrific life events.
No, absolutely. There's a lot to be proud of there. What is a book that everyone should read?
Find Your Why by Simon Sinek.
Mhm.
Um, it's a really compelling, very simple sort of question to ask yourself, but we're only here for a little bit on this planet, and figuring out why we're driven and what's happening on the inside
Mhm.
is it's generally speaking going to be something more than a paycheck, or more than you know than just earning the next you know dollar, or better yield, or better IRR. There's usually
Yeah,
something else there.
I completely agree with you. It's a great book, and I think it's figuring out that why that helps you. I mean, as a business owner, there are tough times and there's going to be problems that have to be solved. And so it's that, I think, that deep understanding of your why that helps you get through those times. When if it was just to make a little money, there might be an easier way,
Yeah,
right?
yeah, for sure. I can tell you that especially doing your own property management, as you probably know, and maybe some of your listeners know, it is hard. It is not an easy world. There's nothing easy about any of this.
Mhm.
Real estate investing, there's 1,001 problems that come at you on a daily basis. Um, but understanding why you're doing it in the end, um, maybe that helps.
Absolutely. Absolutely. And then lastly, what is your number one key to success?
I think it's sticking to my core values. New Standard Equities, we actually have little value pins that we give out. Let's see if I have one actually. Oh, anyway, it's somewhere. But we have little value pins that reward for recognition program.
Mhm.
Um, and it was just something I came up with. Those football players, you get little stars on your helmets or
Oh
whatever it was.
yeah.
I was like, you know what, we could do that. And I put that program together around the core values. We perform, we collaborate, we're creative, and we care. Those are our 4 pillars. And when I see that in action from any of our teams, they get one of those value pins. And so it seems, it's a little it's a little corny. I get it,
Yeah.
but you can't believe how great it works. I had a maintenance guy come up to me maybe about 2 weeks ago, and he pulled me aside and showed me his maintenance shed. And it was good. It was, well organized and whatnot. And he said, "Boy, I really want to get a value pin." I said, "Oh, all right. Thanks, man. I appreciate that you care so much." Okay, awesome. That's great. It's just great stuff. It's like, okay, fine. You want to, more power to
Yeah.
you. But just the idea that gets recognized by somebody at my level, it gets published in our little monthly newsletter,
Yeah.
and it's just a little voice of recognition, I think, that people need. And I think that that's the key to my success, is that my core values, I've imbued them at every level of the company, and hopefully that does well for me. So far it's worked.
Absolutely.
you know
Well, I mean, if you read books, like, well, it's funny. I have one right here. It's The Four Obsessions of an Extraordinary Executive by
oh
Patrick Lencioni.
mm,
And it's just something I was reading recently, and the entire focus of that book is on having core values and how you imbue those core values into the rest of the organization. And so I think that, and you
that's
read a
right.
lot of business books, it really comes down to a few key principles. I think one of them is having your core values, making sure folks are aligned on core values, and then how do you day to day, matriculate those throughout the organization. So I think it
That's
sounds like
right.
you've done that very successfully. And I love the value pin idea. That's a fantastic idea to garner excitement and show appreciation, and to really get those values down to all levels of the company. So it's a fantastic
Thanks.
idea.
Cool. Yeah,
Yeah.
thanks. Yeah, it's worked so far, so good.
Yeah. Well, Eddie, thank you so much for coming on the show and sharing your value
Yeah.
and teaching us a little bit about your business and your markets. If folks want to learn more about New Standard Equities and what you guys are doing, how can they reach out to you?
Info at newstandardequities.com. They can also go on our website. There's a investor portal that you can sign up for if you feel like investing with us. Shoot me an email, ering at newstandardequities.com. I pretty much just sit here and answer email and text messages and phone calls all day. I'm not that busy. I'm happy to take calls and help people out however I can.
Yeah, well, appreciate that, and we'll make sure all that's listed below so folks can click on the links and get access to you. So,
Awesome.
Eddie, thank you so much for coming on. Appreciate the value you brought, and have a great rest of the day.
Thanks a lot, Ken. You too. Take care.